Hey everyone, welcome back to Corporate Decoder. Today, IAC just filed an 8K announcing a separation of trading for their shares and warrants, and I am seeing an important shift in how investors can think about this company. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing tells us that very soon, things that were bundled together will start trading separately, and that can really change how you look at the value of this company. So what we have here is a report that companies file when something significant happens that investors need to know about right away. In this case, Irenic Acquisition Corp, or I.A.C.Q as you might know it, is making a change that starts on the 18th of June. Up until now, if you bought units from I.A.C.Q, those units contain two things, a share of stock and a piece of a warrant. Think of it like buying a gift basket where you get both a chocolate bar and a coupon for a free drink. You get both in one package. These units were issued in their initial public offering or IPO. Each unit is made up of one Class A ordinary share, which is basically a regular share of stock in the company, and 1/3 of a warrant. Now, a warrant is like a ticket that gives you the right to buy a share of stock at a set price in the future. In this case, that price is $11.5 per share. The companies are saying that starting the 18th of June, you can choose to buy or sell just the shares or just the warrants separately. So, you can now buy just the chocolate bar or just the coupon for the free drink, without having to take the whole gift basket. This means the stock will trade under the symbol IACQU and the warrants will trade under I.A.C.Q. This is a pretty common move for special purpose acquisition companies or SPACs after their IPO. It gives investors more flexibility to bet on the company's stock performance versus the potential upside from the warrants. It also allows the market to put a separate price on each component, potentially revealing more about what investors think each part is worth. If you hold these units and want to trade them separately, you'll need to talk to your broker and they will coordinate with the company's transfer agent, Continental Stock Transfer and Trust Company, to split them up. They also make it clear that you won't get fractional warrants when you split them, only whole warrants. This announcement was made on the 12th of June, which is pretty standard for this kind of operational event. This kind of filing is crucial because it directly impacts how investors can now trade and value the different parts of IAC. Irenic Acquisition Corp is what is known as a SPAC, a shell company that takes a private company public through a merger. SPACs themselves don't typically have operations. Their main goal is to find and merge with another company. The IPO for Irenic Acquisition Corp was back in April, aiming to raise about $220 million. The company also checks the box as an emerging growth company. This status allows them to take advantage of certain regulatory accommodations, like not having to provide as much detailed financial history as larger, more established companies. So, what does this mean for investors? This separation of shares and warrants is a signal. It means that the company is moving towards a more defined structure, possibly as they look to finalize a merger or have completed one. It allows the market to price the standalone value of the ordinary shares, reflecting their confidence in the company's actual business operations, and separately price the warrants, which are more speculative and tied to the potential future stock price and exercise strategy. This could lead to more transparent pricing and discovery for both the equity and the options component of the company. It is a step toward making the components more understandable and potentially more liquid for traders and investors. I think this move is generally a positive step for clarity. It allows investors to see the market's valuation of the operating business versus the value derived from the potential future exercise of warrants. It is a cleaner way to look at the company's fundamentals without the bundled unit structure. The risk is that if the market doesn't see strong value in the operating business, the shares might struggle. And the warrants could become less attractive if the stock price doesn't move significantly above that $11.5 exercise price before they expire. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.